Hi, this is Jordan Moorhead with the Austin Real Estate Investing Podcast. Today I got Travis Balcom on, and he's going to tell us all about all the awesome stuff he's done in the past and the big self-storage deal that he's working on right now in Georgetown. Hey, Travis, how are you?
I'm doing good, Jordan. How are you doing?
Good to see you again, man. I know it's been a while since we've connected. It's funny, I just had barbecue for lunch. I think the last time we met in person was over barbecue at Style Switch.
It was, and you introduced a native Texan to white barbecue sauce, and
Oh,
I didn't know if I was gonna like that, but it was delicious.
yeah, the Alabama white wings at Style
Yes.
Switch are really good. Well, cool, man. Let's get right into it. So, most important question we ask here is what's your favorite restaurant in Austin?
Yeah, I would say my favorite restaurant right now is, and it has been for some time. I don't know. I'm a pretty big. I like to eat food, but I would say Soto off
Oh,
Lamar
yeah.
is one of the higher, and just specifically their sashimi. I felt like their sashimi is really high quality compared to a lot of the sashimi out in the Austin
Hmm.
area. But and then there's ATX Cocina is always a big one that we go to when we get down there. So
Nice. Yeah, Soto's got they got the location down on South Lamar, and they've got a location up right on the border of Cedar Park in Austin. I think
yes,
Lakeline Mall.
I've been to both of those. Both, and the fascinating thing is it's almost like two different restaurants. Like the
Hmm.
quality is just as high, but the Cedar Park one has like an omakase dinner set up, and then the one downtown doesn't. It's just more of kind of like an urban sushi restaurant.
Yeah, no, they're both really cool. Awesome. So love Soto, but really quick, could you tell our audience who you are, and how you're involved in real estate investing?
Yeah, name's Travis Baucom. I run a firm called Balcomie Capital. It's a boutique self-storage private equity firm. We buy 4 to 5 or develop 4 to 5 facilities a year. We keep it lean. We're growing fast, but generally speaking, we 100% focus on self-storage. We feel like that has over the next 10 years, that's going to have the biggest return on investment. We're coming into some really odd, unique times that I've never actually experienced in my professional life. I graduated college right in '08, so I never, like it was already crappy when I got in, so I've only had the ramp up or whatever. And then, and so we're about to come into some foreign territory, but storage has a 40-year recession or 40-year track record of being very recession resistant. It'll be interesting to see if that continues. Storage is a lot more levered than it was in the past 40 years. So there might be some REOs happening, but as a firm, we feel like it's the safest, it's the most predictable, it's the cleanest, and it's really the simplest store asset class in real estate that you can invest in.
Yeah, simplest I mean, there's no tenants. There's tenants, but they don't live there. And the construction is really concrete and metal for the most part.
Yeah, for the most part. So going back to the tenant situation, yeah, no one lives there unless you have a squatter, and the
Yeah.
cops will remove them. You don't have to get a judge to say, "Hey, this squatter doesn't belong here."
Hmm.
It's not like a residential property where you have, they don't pay. Then by the next month they're not paying. Well, we got to evict them. It's 27 days they get them evicted in the state of Texas, and then if they leave, great. If not, then you have to get a writ of possession, which is another, I think it's been a while since I've done one, but I think it's $160 still. And then you have to get a sheriff, and then you have to hire guys to clean all their crap out. So you're 60 days in, and then you're 40, 50, 60 days in, and you have to clean it up, paint it, do a make ready, then rent it back out, hoping that tenant pays. Whereas storage, you can have, for the most part, portfolio wide, we have 7 storage facilities now. We have a less than a 2.1% default rate at the beginning of the month, and it ends up being almost nobody it's very rare we have to do an auction. But when we do an auction, it's as simple as on the 5th day they're late, the 16th day we're dropping a new a letter, a public notice in the newspaper. On the 7 days later, you send a second public notice, and then you can schedule an auctioneer to come and you basically auction their stuff off. We've never Most of the stuff that we've had to auction off has been total crap, like a couple empty boxes of
Yeah.
baby clothes and that sort of thing. And so
Mhm.
like for us, it's just getting the unit clean so that we can rent it out to someone who wants to you know, pay us as opposed to not pay us. And so, but yeah, from an efficiency standpoint and a loss of income standpoint, storage is the best because you don't have to deal with a judge. That's the number one reason why it's a lot more efficient to well, it's a lot more easier to kind of collect your money and get people out and really optimize your facility.
Yeah. Yes, that totally makes sense. I know, when we met on in some forum online years ago. You were in a single family flipping and short-term rentals, I think. Is that right?
Yeah, we excuse me, we played a pretty big game in the house flipping business.
Mhm.
We got to where we were flipping 60, 70 houses a year. And as awesome as that sounds, and as like, like champion and like Superman level as that sound, it was some of the most miserable years of my life. If you could imagine, and when I say flipping, we weren't wholesaling. We would
Mhm.
rarely wholesale. We would wholesale stuff like, 200 miles away that we just didn't want to renovate,
Mhm.
that we somehow got somehow. But most of the stuff we were doing, we had crews, in-house crews, construction managers, all that. And we were doing it all in house. And if you can imagine, a typical house has 58 to 110 decisions you have to make before it hits the market. Once it hits the market, a buyer has an emotional response to that. Oh, I think I can see my kids here. I love the backyard. This is a great school district, et cetera, et cetera. They're basically making an emotional decision for you to get paid. And so we did that for 8 years. And
Mhm.
we played towards the end in 2017, we bought 87 houses. And then 2018, we bought 91 houses in 9 months.
Wow.
And it was a business that was not, it was not unusual to get a demand letter right at dinner time for some reason from, a contractor or a upset home buyer or something like that. And man, it just talk about burnout. We just got super burned out. One day I just decided to close it. We were having some cash difficulties, and I was like, this isn't what if this is what running a business is, I don't want to ever run a business again.
Mm.
And so thankfully, when I did that, I was able to clear out we had a ton of inventory, ton of houses under renovation, 72 rentals. We completely, I slowly over 28 months eliminated all of them, or I mean, sold all of them. It took me that long to get rid of all of them. And we had a little bit of cash, and we were like, hey, what are we gonna do next? And that's when I met a couple of dudes that were in the storage industry, and they seemed like they were having a lot better they were a lot happier than I was. So
Mhm.
so that's kind of, and that, so I looked into it and I'm like, I think this is where I want to go, because I feel just like in 2012, multifamily was primarily owned by mom and pop owners, and now
Mhm.
it's like 6% is owned by mom and pop owners. Very few. Most of them are owned by corporate entities. And I
Mhm.
think so. Most of the juice has been squeezed in the multifamily industry. I think the next asset class to get squeezed would be the storage industry. And so right now it's somewhere around 80-85% mom and pop, and it'll
Wow.
slowly get down to that. I'm assuming it'll slowly get down to that 12 to 15%.
Mhm.
That's our kind of bet. We're not really hoping that happens. We think that will happen. When we underwrite a deal, we're underwriting it based on a 3 to 5 year projection of like, we think we can sell it in 5 years for this multiple and get our investors this amount of money back.
Mhm.
But given how much like chatter I'm hearing on like Bigger Pockets and on other forums, and getting wholesale emails for like really, really crappy storage facilities, I
Yeah.
think slowly it's going to go that way. And
Oh,
yeah, and like I said in the past, man, it's so simple, or earlier, it's just so simple to run these. You can run a 400 unit facility with one person, and that's really a part-time job once it's full.
sure. Yeah. Yeah, I know they just don't seem like you need a lot of manpower on site. So did I hear you right? Did you sell all of your rental properties?
Yeah.
Oh, wow.
Well, for the most part. So so when I in October of 2018, I had to let everybody go because I was like, I got like 2 months left of payroll
Mhm.
or mortgage payments.
Mm.
It was going to be what I'm like, and it's going to be the mortgage payments. I'm not going to screw the bank.
Yeah.
And yeah, and so I had 42 renovations going. So rehab, like flips were going like in the middle. I had 5 crews, and I just basically every, I think it was like, I can't remember what days. It was like Tuesday I would travel and hit each crew was hitting one house.
Mm-hmm.
And we would like knock out a house. All right, I need you to go to this next house now. And then I need you to go to this next house. But it took a while. We had 11 houses left when the pandemic hit. And then the pandemic, I was thinking like, dang it, man, like I was almost there. And like, now it's all going to fall apart. And it sucks because I was so close to getting out of it. And then it ended up being the best thing ever because the values went up 20-30% in a year, and then another 20% the next year. So we were able to get out and get a lot of cash back. But yeah, I've still have 4 short-term rentals, which we'll probably keep because I forget that I own them a lot. I have a manager for that. They run pretty smoothly. I don't make a lot of money, but they're in a really good specific location. And here in this, like the Silo district of Waco is where they're located.
Mm-hmm.
I was right next to Chip and Joanna's, like Magnolia Silos, like White Mom Disneyland amusement park thing. So I don't know what you call it, but it's for like mid-40s, like, Disneyland for women. And then we've got, let's see, we did build 5 houses last year with a buddy because we stole some lots, or we bought some lots from a guy that needed to get out of a situation.
Mm-hmm.
And so we have 2 of those left, and then I have 4 just his long-term rentals that essentially I own because they're in such bad shape I can't sell them, or I owe too much money on them, or they're rented out, and then I don't care. I don't need to sell them now. I don't need the money. But yeah, that's it. We got some land, say in the Silo district, but that's about it. Everything else is storage, and it'll just continue to be storage. And so,
nice. No, it's good to focus. I mean, I've paid attention to so many people, and we both know a lot of them that have done really, really well. And what you really realize is that they just pick one thing and they go all in. And when they do that, it seems like they just blow up. You're like, oh my gosh, something happened. They just blew up out of nowhere. And it's no, what really happened, or what looks like happened, is that they focused and just stayed with one thing. So
yeah. And if you when you're focused on one thing, as opposed to like, well, I'm going to try to seller finance houses, buy mobile home parks, develop an RV park, what you see, the chatter you see on the unfocused chatter you see on Facebook or biggerpockets.com or something like that. When you find someone that hyper focuses, you know things that the other people don't know. Like if you stay in your territory, you're going to know when there's an opportunity. Whereas if you're like jumping around on the other territories, you're eventually going to get destroyed by whatever predator is in that, like in that territory. Like if you're the predator in your little box here and a rabbit comes in, you're going to get it. Whereas like if you're in someone else's, if you're in another predator's box, you might just get eaten by that predator. And so you might be the rabbit in that situation, even though you think you might be the guy that, is about to make hay or whatever. And so I know for me, everything after you do a deal of one, let's say a storage deal, the next storage deal, you know exactly what to expect. It gets a lot easier. You know exactly who to call, who, how to structure it, who to, what limited partners are going to be interested, that sort of thing. Whereas if I was like, oh, hey, here's a storage deal, and now's a multifamily project that I'm going to do, and this is a mixed use deal in downtown Austin or wherever, that's very, like we were talking, it was very unfocused. I don't know what the heck I'm doing if I'm doing a mixed use deal. I know what I'm doing in a storage facility, but I don't, so there's all these learning curves, which ultimately cost you money and they cost your investors money. And so we feel like just hyper focusing on one asset class is the best thing to do.
I completely agree. I think that's awesome. So, obviously you've done a lot, Travis. You had a big home flipping business. You had some STRs, you had some rentals, and now you're in self-storage. But what initially attracted you to real estate investing?
Man, so the summers of high school was when the HGTV channel just showed up, and I just remember watching all the house flipping shows. And I just remember one guy was like, "Yeah, well, we do $24 to $27 million in real estate a year." And this is in 2001, so could have been just $1 billion. I was like, holy crap, this guy. And and now I know that was probably gross. He was probably maybe making $500,000 or $1 million on that. But like my thought was like that guy's not that smart. I've been watching all these episodes. He's really kind of a bozo. And and I was like, I bet I can do that. Like I could make 25 million a year. And so I kind of started out that. I kind of shelved it in my brain, went about my life, went to college, and then I discovered my boss. I needed to get a job. So I got a job, and my boss eventually gave me Rich Dad Poor Dad. And I was like, yeah, I'll read it. And then I didn't read it. And then another guy mentioned it. And I was like, maybe I should read that book. That's the book that Kindle recommended. And so like I read it, and it was like I was hooked. So I was like, I didn't want to get a job. I was just like, I'm gonna go right into real estate investing or owning businesses or whatever. Which funny thing, it took another 5 years for me to end up buying my first house. But yeah, that's essentially how I got there. And I think the reason why I got there is from an early age, I knew there was a lot more opportunity for me by watching like the HGTV shows and by reading and talking to my super entrepreneurial boss that I was working for, and realizing like, man, I can make a lot of money working the same amount of time as like working at like a call center, a customer service center. And I honestly, back then, I didn't think I had that. I got this like funny liberal arts degree. I didn't get like a civil engineering degree or anything like that. I just kind of felt like I needed to really jump off into entrepreneurship if I want to ever make any money at all.
So what was your first investment? Like, what was your first investment property?
Yeah, first investment property was a HUD home, and it was I think the price was $45,000. It was a foreclosure. It was in 2012.
Wow.
And the previous owners that got foreclosed on, they stole the toilets, the back, or no, they stole the toilets, they stole the fans and the back door, which I always thought was funny. I'm like, dude, you're not gonna, like, yeah, you really, like, you can't, like, the toilets are really hard to put somewhere, like, what are you doing? And but then the back door was such an odd thing. And so I paid like I think I paid 42,000 for it. It was real long close because it was owned by the government, HUD home or whatever. And then we put 12 into it. That was the only house I actually did the painting and did the flooring and stuff, because I didn't have a job at the time. We had just moved to where we live now in Waco, and my wife was a nurse, and we had a 9-month-old baby. I'd bring her with me, and I'd paint. And I'd try to lay flooring. I'd try to do this. I'm not good at handyman stuff. But the cool thing is I put it right when I closed it. The first thing I did, I put a for rent sign, and I rented it out one before I was done with the renovations, like setting the toilets basically. And two, I rented out before my first mortgage payment was due. And so, which was great because, as previously mentioned, I didn't have a job. My wife was a nurse, and we were pretty broke. Like we just had enough money to buy a house, so, or like buy an investment property, and then we're like, get it figured out from that point. But yeah, once I told my wife that she was kind of hesitant at first. Once I told her I rented it out before the mortgage payment was due, she was like bragging to her mom, like, yeah, you rented it out before the mortgage paper. Yeah, I'm gonna tell him to do a lot. I'm just gonna. And so she's like, yeah, go just do some more of those. And so after the one, she trusted me the rest of the time, I guess.
So did you start flipping right away? Because it sounds like that first one was just a pure rental, right?
Yeah, that was a rental. The second one I did was a flip, and I lost money on it. And that was when I was like, man, I can't do that again. And so, like, because I just didn't have the ability to do it. Third one made money. Fourth one made money. Fifth one made money. The sixth one, I was feeling pretty cocky, so I bought a house 2 hours. I bought a house in a really expensive area of Dallas, and I drove up there every day. I'm like, my thought was like, I can make 20-30 grand on a deal here in Waco, or I can make 250 on a deal in Dallas, which is total bull crap. It was not the case. Terrible experience. 14 months, almost every day having to go up there managing crews and stuff.
Gosh.
Leaving at 6 a.m., getting there about 8:30 when everyone was showing up, leaving the job site at like 3 to get home to get ready for dinner, have dinner, start to cook dinner, and get my kiddos ready. But yeah, that deal we ended up losing $250,000 on. And so,
Oh my gosh.
and that's, that's when I was like, I got to figure this out, or I'm going to have to go do something else.
Hmm.
And so, and thankfully I met a guy that taught me how to like send letters out,
Hmm.
um, like, direct mail basically. And that
Hmm.
changed my life. We went from buying 3 houses a year to getting like 28 calls a month, and that like buying one a month. And I'm like, oh, this
Hmm.
is great. And that's when I was like, well, what am I going to do with all this stuff? And I had to bring in partners. And I was like, well, I guess I'll sell this one to you for this because I can't get to it. And that was, and then it just kind of it spiraled. I kept on finding people that were really good at finding deals. Like a guy that was really good at buying on auction websites. I hired him. He ended up buying 11 houses his first month. And I'm like, I
Wow.
don't know how to finance these. I went up to him and was like, hey, just FYI, I don't know how to finance these. I want to see what I can do, but I don't have this type of money. I didn't expect you to do it that fast. And they were all good deals. That's the thing. They weren't like marginal deals. This is like 2014 when
Hmm.
like the world hadn't taken off yet as far as like the economy and everyone thinking they can flip houses. So you can still get deals where you can make 80 to 100 grand, 50, I would say 18 to 20% return on your investment within a
Wow.
few short months. And so, and back then it was really great. And it was great to brag. But then like in 2016, a whole lot of money flooded the market just because we had a more business friendly cabinet, president, and then just everything had, as anyone listening to this that's been doing this for a while, everything just dried up. It just got real hard to
Hmm.
make money, especially when you had an office and you had people, you had payroll, and you had in-house crews, and you had $18,000 a month in marketing. You spend $90,000 a month just keeping the doors open. It's not fun. So
Yeah. Yeah. Well, especially when you're hunting down those deals like that. And there's so many variables with flipping. So yeah, flipping can be a great business, and there's a lot of people that make a lot of money doing it, but you've got to be very prepared for when things change or get harder, like you're saying,
yeah, and
open
I would
season there for a
say
while.
it's a good way. It's a good place to start to really get going, but you don't know a lot of 20-year veteran flippers. They kind of move on to something else. And I think
Mm-hmm.
there's good reason, because like it's impossible to perfect because every house
Mm-hmm.
is different, and then the market changes so much. Like right now, I have several friends or several guys I know who reach out and they're like, "What do I do? I'm in this thing for 300. It was going to be worth 400. Now it's worth like 330, but I went over budget, so my cost is like 360. I'm going to be losing money. Like, what do you? I know you were in a similar situation like this. What do you think we should do?" And I'm like, "Geez."
Yeah.
I get like the thing that I got really lucky on is the market kept on going up,
Mm-hmm.
and right now the market's not going up; it's going down. Uh, Depending on who you talk to, so,
Mm-hmm.
and depending on the asset class, I guess.
Yeah,
But yeah,
just the
it's
specific areas. There's one side of the
yeah,
highway in Austin where everything's still rosy, and you go over to the other side, and prices have kind of stalled out. So it's
it's
so
fascinating,
many different things, variables there.
very fascinating.
Hmm. Yeah. So you flipped for what, 6, 8 years there?
8 years.
8 years. Grew a really big business. Got to the point where you said, I don't really want to do this anymore. That Dallas one just sounds brutal. I mean,
Well, so
the four
that was
hours
only
a day of
one.
driving.
That was just, I did 2 houses in Dallas. That was the first one. The second one, the neighbor sued me and locked, and he clouded my title for a very long time. That was the most
Wow.
brutal one emotionally. The other one
Hmm.
was just a financial loss.
Yeah.
You're like, I'm getting out of Dallas. I'm never going to do anything up here again. And so, yeah, it's the thing is like, yeah, they were terrible. It was awful. I never want to go through anything like that ever again. And still today, I get nervous when I'm doing a big deal. I'm like, well,
Hmm.
what did I miss? Is there like, who's a neighbor? You think about that stuff. Like, do I have a good general contractor? Because now I'm playing with a lot more zeros. And
Mm.
so, if I take a 20% loss in something, then I don't have that money. And
Hmm.
so, but with that said, like, I'm glad that I went through those uh trials and that suffering, because I know what to look for. I've been able to pivot. I've been able to learn from them. I know how to think about things. I know how to deal with lawsuits. all that education came, like my buddy, he calls it experience tokens. You got to take all those experience tokens. You're getting a lot of experience tokens. Eventually you get to cash those tokens in and you'll be fine. So
That's a cool way to look at the experience tokens. I have a few myself. So speaking of experience tokens, what's the biggest mistake you would say you've ever made in when it comes to real estate investing?
well, I've given you a lot.
Yeah, no,
So,
you've given me a bunch of really good ones.
yeah, man, I would say growing too fast. And so if I could have kept my business, my house flipping business around like a 15 to 20, maybe even 30, house a year business, it probably would have been fine, because that would have been a pretty top light model. I could have had just one, maybe two people working for me. And, like I know when my business was doing 25 to 37 deals a year, like I got to work, I was working out like 2 hours a week. I mean, 2 hours a day in the morning, show up, make sure everything's going smoothly, go check on jobs. I didn't have too many jobs to check on, so I would check on them, and then I would go back and, try to meet with a private investor, something like that. It was a pretty nice little humming machine. But I guess to put like a phrase into what was my biggest real estate investing mistake was I got my ego got into the way. Like it's just massive ego. I was always trying to make sure, I was trying to impress and prove to other people how good I was. Like, oh, you doubted me, now I'm going to get you now. But the reality is, when I got to that point, none of those people freaking gave a crap. Like they weren't even paying attention to me. Like I built this business to impress others, and none of them gave two shits about me. And that's the thing. And that's kind of general how life works. Like we feel like life is, we're trying to prove ourselves to others, but they're also trying to prove themselves to us, because it all kind of revolves around the same insecurity that I feel like American, and I'm sure it's outside of America too, but just that Americans deal with. But yeah, I would say my biggest mistake is letting my ego get in the way. And that encompasses not looking at the numbers deeply enough. That encompasses trying to buy too many houses when you knew you didn't have the cash to do so. It encompasses overpaying for houses just so that you can get your numbers up, so you can impress everybody at your mastermind that you're going to the next week. All that stuff was the biggest mistake. So
yeah, getting over your skis, kind of what it sounds
sure.
like. Yeah,
For sure.
cool.
And knowing I was over my skis, but not telling anybody I was over my skis, because I was too prideful and too egotistical to humble myself.
Yeah, ego is definitely the enemy. So if you had to start over today, let's say with just the flipping business, if you're saying, hey, I'm gonna get into flipping and I'm gonna do it really well, would you do anything differently?
I don't really know.
Or
I
would you
want to
just not
say,
doing the flipping business?
well, that I want to say I just wouldn't do the flipping business,
Mhm.
but I think that's a good, like, when I bought my first house, I had $2,500 in the bank,
Oh, wow.
and buying a house and renting it out for $900 was like a lot of money. That was a $300, $400, net cash flow to me. And then when the second house I flipped, I didn't do very well on, but the third, fourth, and fifth, I made like 20 to 40 grand on those, each one of those. And that like changed my life in a sense, like I was able to pay off my car. I was able to still shore up some capital. So if you're a teacher or an Uber driver, or a postal worker, or just someone that just wants to jump into real estate investing, I'd probably still encourage you to do house flipping. Not right now, but generally speaking, like house flipping is a good like stair step to get to the next asset class. But I would also say, once you get about 100 grand of cash in the bank, and you don't have to live on that, meaning like maybe you're siphoning like 10 grand, 5 to 10 grand of that month, 5 to 10 grand of that money out. Like I would say, hey, it's time for you to go find a bigger project that you can put a $30,000 to $50,000 earnest money down, fee or earnest money check on, and then go then syndicate that deal, like raise money. It's a lot easier. Raising money is easier than most people think. And then, get an attorney, pay an attorney to come up with some, syndication docs, like a private placement memorandum, and some subscription docs for that PPM. and then go that way. And then also when you buy that, you can actually charge yourself a fee. And then that's where that's when it starts really getting good, is you like structured a deal. You have this big, let's say 40 unit or 50 unit multifamily project, or a 200 unit self-storage facility. And then you got paid to do that deal up front, like 3 to 5% of the purchase price. And then you also have reserves that you raise alongside for that asset alone. And then you have a nice 25% down payment that you raise from your limited partners. And then at that point, it's a 3 to 5 year cycle, and you made enough money that you don't have to flip any houses anymore. You can go find another apartment complex to do that on, and you do 2 or 3 of those, and you pay yourself $100,000 each. There's a $300,000 income. And it does not take as much time to run 3 storage facilities or 3 multifamily projects as it does to try to make the same amount of money house flipping. And in a way, it's less risky to do the multifamily and the self-storage facilities as opposed to the house flipping stuff. So that is what I think the greatest model is: get enough money to go and start doing bigger stuff. Because if you think about the people that we know, but like other people, like the people that are really living a lifestyle that is really really appealing, maybe they have a bigger house, maybe they have drive a nice car, maybe they don't have either of those, but man, they're skiing 20, 30 days a year, and snow skiing 20, 30 days a year, or surfing a lot, or riding mountain bikes a lot. Like if you look at what their businesses are, I guarantee you most of them will probably be some sort of commercial real estate.
Yeah, there's something where you can have a team, and it's not all on you too. Cool. So just to recap, really, if you're going to start over differently, you would start and you would get going with house flipping or smaller rental properties until you had enough money to then get into commercial real estate really as quickly as possible, right?
Right. That's absolutely. That's because for me, like I was scoffing at like $20,000 a door properties here. I was flipping at a little bit of money, could have totally done what I just said, the model I just said, but I was scoffing like, oh, this is too expensive. Well, those damn $20,000 Class C properties eventually traded for like 110,000 in 2021. Like it would have been a really good business to get into. And so, but yeah, I would say start house flipping. That's a good place to start. It's something it's something you can find easily. Once you make 50 to 100K, partner with someone like me you could come in as a co-sponsor and we could do a deal together, or you can do your own deals and just read books about how to syndicate a deal, basically.
Yeah. Oh, I like what you said about partnering with somebody just to get your foot in the door. So I think that's so important. So many people, I need to have it all. Well, if you can get your foot in the door and partner with somebody like Travis on, say, a self-storage deal, then the next deal is going to be infinitesimally easier.
100%.
You're just going to scale up so much faster. So that's awesome. That's great advice, man. I think that, again, I really like studying people who've been really successful. And everyone that I talked to basically said I would have gone bigger faster.
Fascinating you say that. Robert Herjavec said that.
Yeah, did he?
At a Go Abundance deal. I have it on my mirror. He goes, what's the one thing I think Daniel Del Rio asked him, hey, what's the one thing you regret? And he goes, I would have gone bigger. I would have chosen to play a way bigger game, or I would have chosen to play bigger way faster, or something like that.
Yeah. Yeah. I mean, that you boil it down, that's basically what everybody's saying. Say, I started, I'm glad I did what I did, but I shouldn't have hung out there so long. Not that it doesn't work. Like you're saying, if you had a flipping business, flipping 30 to 40 houses a year, you're going to make good money doing that. Then you can set it up to where it's not as much work, but also, like you said, it might be easier to do 3 bigger deals a year.
Because with the bigger deals, you can get non-recourse loans. You can get, you can have property managers run it for you, and then your job, you're an asset manager at that point, instead of a renovation company that's taking all the risk on buying houses. Like a house flipping business really is you have like a remodeling company model. taking on way too much risk by actually owning the asset instead of just charging the homeowner cost plus 20%.
Yeah.
So,
And this is not to denounce flipping or say flipping is a bad idea, but I had lunch with a lady yesterday. She flipped a lot of houses in the 80s and 90s in Austin. She had one go wrong and had to write a check for double what she sold the house for to get this
wow.
person off her back. And really, it was the best thing she could have done because her time was worth so much more money being focused on what she was doing, and this was pulling her away from her family and her business and everything else she was working at. So
Wow.
yeah,
It's a slog. It can, like there's house flippers have that one. You're like, yeah, I made 100 grand on that.
mhm,
I made 200 grand on that. But every time there's 100 to 200,000 there, there's a few that they lost a whole bunch. And if they didn't lose, it was like a slog to get through. They didn't sell. They sat around for 18 months.
mhm,
Finally got a lowball offer, and you're like, I'm just done with this. We had a property in a small town outside of Waco, Groesbeck, and we could not get. It was a rental property, and it was a nice rental property. It was substantially nicer than all the houses around it, but because we were out of towners and we didn't live there, we could not get the electricity to be turned on because the city kept on saying, well, we need you to do this. I mean, well, I don't think like cutting a tree down that in the back of my house, like I don't like, it was like silly stuff. Like I had to cut the tree down like an acre back at the back end of my property, so
wow,
that, and then I did that, and they're like, all right, well, thanks for doing that. We found these other 9 things you have to do, and that
oh my
like went
gosh,
on for almost 2 years. And I remember like gladly we had to write a $32,000 check to get out of that one. And
wow.
I was like, that was the best money I've ever spent. And and then and then if yeah, I won't say since I wasn't gonna say something else, so I want to say that now. But yeah, it was, that was the best money to get out of that deal. And I'm like, I'll never buy anything in Groesbeck ever again.
You're done with that town. Well, cool. So Travis, you're doing a few self-storage deals a year now. What's next for you? What are your long-term goals, and what's your vision for real estate investing for yourself now?
Yeah, we we're gonna just kind of keep doing what we've been doing over the last 2
Mhm,
years. Our goal is to develop one large facility in a major metropolitan area in a Sunbelt state every year,
mhm,
and then buy 3 to 4 existing facilities, um, also in the Sunbelt states or
mhm,
really close to Sunbelt states, that are in existence that exist already, but have been mismanaged. We can either get close to raising the rents like 30-40%, or we can expand on it. So we've got a couple projects like that going on right now. We got a deal in Edmond, Oklahoma,
mhm.
that the market, like, after redoing all the research on the market, it looked like we could double rents right after we bought it, and so we did.
Wow,
And revenue is up 40% now compared
wow.
to when we bought it back in September. And then so I'll tell you more about that. The crazy thing about that one is revenues were about 30 grand a year, 30 grand a
Mhm,
month, and at 100% occupancy.
mhm.
We doubled the rents, upset a lot of people. A lot of people moved out. We're at 60% occupancy, but our revenue is 41,000 a month right now. And so all we
Wow.
have to do is play the waiting game and just make sure we're marketing well and just fill that thing up. And then we paid 6 million for it. And after filling up, we should be able to get 11, possibly 12, depending on where interest rates go.
Yeah.
But we're pretty excited about that one. And then we have one in Waxahachie, Texas, that was
Mhm,
a real small facility, but it's on the highway. There's no other storage facilities in a 5-mile radius, and so we're the only ones that can serve that whole area.
mm,
And we're adding, right before I call, I was signing purchase orders for 20,000 modular units to just be able to drop in 4 weeks. So we'll go from 7,000 square foot facility, which is way too small to buy ever,
mhm.
to 30,000 square foot facility.
Wow. So you're just
Yeah, that's
dropping.
right. I think that's right. I think those numbers are right. It's yeah, 20. Yeah, we bought 23,000 square feet of modular stuff,
Mm.
and so
So sorry, I'm unfamiliar with modular
sure.
self-storage. Do you put down concrete and then just drop these on them, or how's that work?
Well, yeah. So you know, the city, you tell the city, like, hey,
Mhm,
this is equipment, right? And so like, because it is, you drop them and it's kind of like a pod or a roll off, but it's a lot nicer, a lot higher quality. And you drop it and you put the next one right next to it. And then you have like an entire, like, 20, 30 of these in a row. And then you tack weld on the top of them. And they're basically a storage facility that's built up on, a pad. Like the pad, like the dirt guy makes sure the pad can hold the weight and that sort of thing. But it's a good way to build in areas that otherwise would not be feasible to build. So let's say if we were to go to the city and like, we're going to put 23,000 feet here, they would say, well, you can only do 18 because we need a detention pond and you can't use gravel. You have to use concrete. Well, like, this is out in the middle. This deal is in the middle of Waxahachie and Ennis. So there's a lot of like, it's kind of a rural area. There's going to be more 4-wheelers in those units than, something nicer. It's going to be a lot more toys like that, as opposed to like, mattresses and dining sets and that sort of thing. So we didn't want to take on the $50,000 engineering expense and an additional like $120,000 like site grading and stuff like that to get to that point where we can add 18. So and then there was like setbacks here, and a big setback there, and there's all this other stuff we had to do with TxDOT if we were to do that. So what we've done, we're just going to drop them, and when they say, hey, I don't have a permit for this, we can say, well, that's okay, because this is just equipment. We can literally take these tomorrow. And that's a true statement. Like, it's not like those can be portable anywhere you want them to be. And so as long as if you don't tack weld them, they're portable. But yeah, that's our plan on that one, and that should work. That's a good plan for that specific thing. I don't know if I would use it, like on a Austin MSA storage facility unit complex or something like that. It's kind of, when you're getting less than $12 annually for rent, you're like, that will probably work. Whereas like in a lot of places of Austin, you're getting $21 to $24 annually for rent. You need to have a little bit higher grade of a storage unit. So
yeah, as those people are going to have their mattresses and all that sort of stuff in there.
Yeah, wine's a real big popular thing in a lot of the climate control in Austin. Wine collection.
I had no idea. Not a wine collector, so I didn't know that was something you did with self-storage.
Yeah, I think it's the conditioned space.
Yeah,
some self-storage facilities literally have a wine room that you can rent out, and it's like per square foot is like $35 a month.
Oh my gosh!
But you only have like 1,500 square feet, so that's for like several people to go and put their little 3 or 4, special reserve Camus bottles or something in there. So,
okay. So I know you're working on one here in Georgetown too. You want to talk about that a little bit?
Yeah, I'd love to. So that was actually the original plan, is to build 10 to 15 in Austin MSA, like just from the ground up, have them branded, extra space or live storage. It's taken over 2 years to get us to this point. We still don't have permits. We should have permits on the 23rd of March.
Nice.
And then we should be digging dirt early May, hopefully. And but yeah, it's right at the corner of Williams Drive and DB Wood, one of the major intersections of Georgetown. It's across the street from HEB. It's next to McDonald's, a CVS, a Whataburger, a Starbucks. So there's tons of traffic flowing in that area. And the reason why that's a good thing is because about 50% of your marketing is drive-by traffic. And so they'll see your facility there and they're like, I need to go get myself 10 by 10 so I can put whatever is annoying me in my garage in there. And so it's 2 buildings. It's collectively it's 147,000 square feet net rentable, meaning like what we can actually rent out is 107 to 111, depending on how it's going to shape out. But $18 million project. Stabilized, that's the cost. The cost base is 18 million. Stabilized value is 27 to 30 million. And we should be stabilized by year 5. More than likely, facilities that size get bought by publicly traded companies. And if you remember my comment about house flippers, I may have not made it yet, but I felt like all the competition for house flipping. I was a professional house flipper, but my competition was like teachers that were doing it on the side, Uber drivers, youth pastors. And I was like, I'm going to create a business model that whatever I invest in, the largest people are going to be investing that. That I want to build facilities that publicly traded companies go, yeah, I want that in our portfolio. And
Yeah.
so we feel like it's finally coming to fruition. We've been working with the city of Georgetown through COVID, through all that other stuff. It's almost May will be 2 years since I got the land under contract.
Oh, wow.
So we closed on it in December 21, but we had been working on. I think we filed permits in May as well, and so it's taken a long time, and that's kind of normal. This is taking a little bit longer because of just city of Georgetown just is overwhelmed with a tremendous amount of development because it's a city that's grown 35% in the last 5 years, and like healthy growth is somewhere around 2% a year. So it should have grown like 10%. It's grown 3.5 times that. So if you can imagine the demand on the planning and zoning committee or planning and zoning department in Georgetown, it's probably unreal. But and it's when you have that much going on, you're gonna make mistakes. You're gonna forget you're gonna send the wrong comments, all that stuff. So
yeah, and they're not incentivized to work any faster either. They still just got the same old job.
They're not. And I would just say this, like every person every person I've talked to at the city of Georgetown is an incredible human being. Like they're very helpful. They're very smart. A lot of them have like upper level degrees. They're not dumb people.
Yeah.
But yeah, it's definitely like it's a lower paying job. First off, it's a very high stakes job in this sense. Like there's a lot of pressure because there's just so much development going. So what happens is you work there for 6 months to a year, 18 months, and then you leave to go work at a company like mine or something that needs someone who's really familiar with the zoning department of certain municipalities to be able to champion the effort on getting stuff approved. And so if you think about how the turnover, there was still a lot of COVID protocols when we first started doing this. It's just taking a long time, but dude, it's gonna be awesome. It's gonna be I think this is where for our firm, this is kind of the next level. And so when we can compete, when we can build the same thing that Hines Development or WP Carey are building, and when we can build something that Life Storage or Extra Space, the second largest facility owner in America can buy, then we're playing on a different level. And that was the whole goal, is to get us far away from kind of a basic level of investing. We really wanted to get to that next level of where the people buying stuff from us don't buy it don't get the same loans we get. They get loans from SOFR, and they get loans from bond releases and that sort of thing.
Yeah, you're playing with the institutional guys there.
Yeah, for sure.
That's awesome. Travis, do you have a favorite book that you like to recommend to people?
Yeah, I read a lot, and by read a lot, I mean I listen to books a lot because I have four kids and obviously a ton of real estate. I'm get a lot going on. So my favorite book ever, and I started reading it right when the pandemic happened, is Obstacle is the Way by Ryan Holiday. I've read that book like 37 times, maybe more than that now. Like I'll finish it. The first time I listened to it, I'm like, okay, that was a lot of good stuff. I want to reread it now. And then I'm like, I want to read it again. I want to read it. And then it was just like, and then, things happened in my life with my daughter. She almost died, and, like fell back into that book. And like 2 years ago, she did that. And then I went, I had a very hard time during that time. So that book really helped me kind of process a lot of stuff that was going on, along with like several other like professional help. And so and then I would, if I can, there's another book specifically on real estate investing that or it's not a real estate investing book, but it is an investing I would say the best investing book anyone can read.
Mm-hmm.
And I discovered it because I kept on pitching a family office, like, hey, this is the deal I want to do. I think this is good. And like in 5 minutes, they're saying no. And it's just like, it happened. The family office happened to be someone who I really looked up to and was like a mentor. And I'm like, man, why the hell does his office keep on saying no? And his family office guy one day goes, hey, Travis, I need you to read this book. Here, David told me to give you this book. And so, and it was a book called Margin of Safety by Seth Klarman.
Oh, cool.
For real estate investors, you're not going to understand part 3. It's like hyper, like stock market investing, like dividend. It was so far, like, I felt like it was a different language, but the first part and the second part are is gold. Ever since I read that book, I've not lost money on real estate. And I read it in 2018 after whenever everything was falling apart. I read it and I was like, this is a great book. So it's not in print anymore. You can get like a legacy copy on Amazon for like $1,500 or maybe even more now. But there was a digital copy on Etsy for $9.99 that you could download, take to the UPS store, and they would bind it. And that's what I did. And I just read the whole thing. And I think the blessing and the blessing and the curse for real estate investors are that most of us are visionaries. We see like, man, that grass can be a really badass storage facility or a multi-family property, or that house that the roof is caving in can be really beautiful if we fix it up. You know, while we get really excited about the ups, and we don't even think about the downs. And so margin of safety is always about like, yeah, everyone can get excited about making money. How do you make sure you protect your downside? And so like Seth Klarman is worth somewhere around 15 billion, I think, according to Wikipedia. And he goes, the goal is as long as you don't lose money, you'll continually increase your net worth. And he goes, you can even break even, and that's better than losing money, because you still have your principal balance. Whereas if you lose, let's say you lose 15% and your goal is to make 15%, now you have to make 30% to get just to your original goal, or you have to make a 15% return, which is pretty hard to get back to break even. And then you have to swing, you have to win again and win again and win again. And his whole point is to, if you just make sure you protect your principal, you'll be fine. And so ever since then, I'm like, how do I structure my business? Whereas like, if things don't go well, I'm still in business and I can keep doing it and take the lessons I learned to keep doing it. Whereas with the house flipping business, man, there was some times where I'm like, this might not work out. So I might be done here. So
that's a good, I'll look for that book too. I might do that Etsy thing, but I'll definitely try to seek it out. Travis, is there a best way people can get a hold of you or follow you or learn more about Balcomie Capital?
Yeah, the best way is to go to balcomiecapital.com. And that's if you want to see our investment offerings, if you want to hear more about that Georgetown deal, I would recommend that. If you're listening, that would be like an accredited investor to go there. Another way is to go to housetoempire.com, which is where I teach. I do individual coaching on teaching people to go from house flipping to buying commercial properties. And then you can also get me on Instagram at Travis_Baucom. It's BAUCOM.
Awesome. And we'll have all that in the show notes for everybody. Travis, thank you so much for coming on here today. You know, everybody reach out to Travis on Instagram at Travis_Balcom, BAUCOM. And you can always follow me on Instagram at Jordan_Moorhead. Also, if you're looking to learn more about Travis's investments for accredited investors, balcomiecapital.com. And if you're looking to learn how to go from house flipper to commercial real estate investor, housetoempire.com. Again, guys, we'll have all that in the show notes for everybody, so you can reach out to Travis and learn everything you can about him. Thanks, Travis. It's good to see you again, man. We'll have to get together in person here soon.
Yeah, that was fun. I enjoyed that. I hope it was good.
Absolutely. Next time you're in Austin, give me a ring.
Will do, buddy. Take care, Jordan.
Thank you.